Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you. Welcome to Real Estate Risk Report. I'm Lance Pederson. Today I have with me Chris Mills. How you doing, Chris?
Doing very well, Lance. Thanks for having me.
Yeah, my pleasure, man. So pretty excited to have Chris on today. Chris is sort of a rare, he's a rare bird in the industry, and I'll let him sort of explain a little bit further. But he helps high net worth investors and individuals, build portfolios of, that contain alternative investments, and specifically maybe a Delaware statutory trust, that they're taking capital gains, that they had from, selling some property, and they're trying to, continue to make it tax efficient or whatever the case may be. But he also has a background, where he's been a real estate sponsor himself. He's owned real estate, bought real estate, managed real estate, a lot of a very in-depth kind of real estate background, but he's now transitioned into, some financial planning and, helping people kind of, navigate that. And, he has kind of a dual designation of, he's got the FINRA side and the SEC side, which we'll go into later episodes, but you really don't find people like Chris very often. So I think at the heart of today's discussion, we're going to kind of hit on the notion of, could someone, what is too much exposure to alternative investments, right? I mean, we come from a world where, it used to be, and I think it still is the case that, people didn't have enough exposure to sort of alternative investments, right? Because you could get pretty much everything you needed in the public markets. And now we're seeing that the private markets, dwarf the size of the, especially in new issuances and things like that. And of course, unfortunately for your average garden variety retail investor who's not accredited, it takes a lot of the options off the table. But I think that what's interesting to me is sort of the notion of, we've all followed and sort of picked up on, the Yale endowment model. And obviously that's a gigantic endowment. But they are very, very, very heavily weighted in alternative investments. I'm not even sure what the percentage is these days in sort of liquid, publicly traded stuff, but it's pretty low. And of course, I know people who have, 95% of their net worth, and these are people who have significant net worths that are entirely, 95% of it. So nearly the entire amount is in sort of alternative investments with a super heavy weighting in real estate. So Chris, why don't you just share a little bit about your background, kind of get us up to speed, and maybe start speaking to that in particular and how you kind of look at that portfolio, building a portfolio, and what's too much and that sort of thing.
Sure. So I started investing in 2004 and, very quickly and aggressively started to build my portfolio. I was wholesaling and doing buy and hold, single family, multifamily, really anything, everything, and some mixed use as well. I'm in DC. Right now I'm in Virginia, right outside DC. So I've kind of covered the whole area. Maryland, Northern Virginia, and mostly at that time, especially DC. Started a property management company, and eventually that morphed into an asset management company once I started going more national. So just kind of managing property managers, if you will, just making sure things are performing the way they should, portfolio optimization type stuff. Then, DC market changed. So I started looking to Ohio, Texas, North Carolina, really, expanding my reach, having a lot of conversations with folks here who were kind of stuck, like, well, I'm not comfortable going that far away. Some folks maybe invest in Baltimore, which is about a half hour up the road from where we were in DC. But that was about it. So I went ahead and went national and moved my family. The moving and stuff got old. So once I had a few kids, I moved out to about an hour outside DC, and started to slow down and everything. But then, one thing led to another through a series of events and introductions. Multiple people suggested that I go ahead and get my securities license in order to sell DSTs, because the asset management stuff that I was doing, this kind of stuff kept coming up. And some of the sponsors that I met, they said, you would do really, really well. You'd serve the industry really well with your background if you started doing DSTs and some of these alternative investments. So studied up, fell in love with it, talked to a longtime friend and joined his family firm. So now that's what I do today. I specialize in the DSTs, opportunity zone funds, income funds, a lot of the real estate based stuff. I take my experience from the mixed use properties, the multifamily properties, and put it to work whenever I get these investments across my desk. I cross analyze things. I make sure everything's on the up and up. Things have gotten a lot better, higher quality, I'll say, or more conservative, depending on how you look at it. A lot of the DSTs and some of these investments that came across my desk pre-COVID, I wouldn't actually be comfortable recommending. People have
because the market was so overheated. You mean like even the basis they're getting in with this like stabilized? Because DSTs typically are holding stable commercial real estate,
class A,
with low leverage, often, right? I mean, like
right.
Usually nothing more than 60%, right?
Right. They have to hover around 50 to 54% because, the 1031 exchange has very specific regs for your debt and equity and things matching as close as possible for the sake of the deal. So they are very conservative, but some of the stuff, to contrast now, I'm seeing a lot of, not so aggressive deals. I'm seeing a lot of, even the retail stuff is defensive, like AutoZones, Dollar Generals, things of that nature. A lot of the more or medical stuff. If it's office, it's usually medical. I'm not seeing a lot of speculative stuff, hotel Hail Mary type stuff. Like folks are being a lot more careful now.
In the DST space.
Correct.
Because the ozone space is like the polar opposite. Although, you can, it's basically you can take gains and go into some opportunity zone fund deal, but it's, by its very design is not conservative, is not stable. It's development. Like it goes from.
It's a very aggressive play. Yeah, exactly. By its nature, like you said. So definitely not talking about those. They are what they are.
Yeah, it's just interesting to hear you say that there was more risky DST stuff, right? Like it seems like
not so much. Not so much risky. It's just I do my own. Like when we talked before, if I get a sales brochure or some PDF in my email, I'm not just going to look at those numbers. Take it for granted and then refer it to a client. Say, here you go. This is going to perform this way. I do my own due diligence. I go visit. I send my team out if I have a team in that area. And if I'm looking at rent rolls or their expenses, and I say, on a building this size, your water and utilities and stuff should really be this. Maybe their numbers don't hold really true. That's when I say I would be uncomfortable, right? Like if my research doesn't line up with what they're saying, then I'll either dig in more or just go on to the next deal. I wouldn't be comfortable if my due diligence isn't coming up with the same thing and saying it's a good deal, then I'm not comfortable passing it on to a client.
That's crazy because you think about it, like before that brochure hit your desk, because you're on the regulated side, that means that some sponsor had already engaged a broker dealer to distribute their product. They probably have wholesalers, I'm guessing, right? People that wake up and go to work at the sponsor every day, and they're basically dialing guys like you all day long. Chris, did you get my flyer? Did you get my flyer? Did you get my flyer? What do you think of the deal, right? And more often than not, you correct me if I'm wrong, but there's going to be sales load of let's just call it 10%. There's some amount that investor is going to pay, right, in order, to gain access to that product, right, to solve that problem. How do I roll these gains? So, and I'm also assuming that sponsor on that deal got a due diligence report from Mick Law or Buttonwood or FactRight, correct?
Somebody, yeah.
So someone's in theory vetted this deal. It's been broker dealer vetted. And what I hear you saying is it's hitting your desk. And as a real estate professional, I mean, as a guy who has a real estate background, right? Who's been, you've been in the trenches. Once again, that's how you got into this space, because you understand what you're talking about. You're looking at pro formas on deals that are stable. And even you are looking at them going, what? Like, this doesn't I get it. Like in a value add deal, like, in the non-broker dealer world, right? It's value add multifamily. I mean, that's the epidemic, right? Is that everyone in the name of sort of drawing attention knows that they need to put out, if it's a value add multifamily deal, then they better be projecting 18 IRRs and 2x equity multiples, or you're just not going to get any love. Now, the reality of it is that in the up market, when the market was just going gangbusters up and up and up, everyone looked like a bunch of geniuses, which is just how it goes. I mean, hey, no judgment there. But the reality of it is that everyone's not everyone, the majority of people's pro formas are out. They're too aggressive, and they're doing it for because for the sake of marketing. And all the guys that'll tell you that just feel like they really do put out pro formas that they think are conservative, and I legitimately are, they'll tell you that's their biggest struggle. They can't stomach doing that and playing that game. So they're putting out 14 IRRs because they just believe that this is just, there is gravity in the world that's going to hold you down, market forces. So it's really interesting for me to hear that. Like, even when you hit stuff, you're doing your scrubbing because you know what you're doing. You can tell that things aren't quite what they seem up front. And I believe it. I mean, and that does make sense that would still happen, but it just kind of shows you, because the name of this is the real estate risk report, right? Like, you can't, like, I get it. I mean, like, having been a register rep myself in the past and passing the test and being, and being regulated by FINRA and broker dealer and all that stuff. I mean, like, yeah, I mean, there's definitely, there's lots of stuff going on. And in theory, it should protect people. And you've got a bunch of set of eyes on things. And especially when it comes to misrepresentations and, those sorts of things, you just can't flash things around and flashy objects and shiny objects to get people all hot and bothered about stuff. And I think that's good. But, ultimately it's everything that's done, everyone needs, you can't just blindly go into anything, right? I mean, like I say, when I introduced you, I mean, you're a rare bird. Like, it's hard to find people who have a genuine sort of, like, a true genuine concern and then also have the competency to back it up, who know what they're looking at. Right. And so just because your golf buddy says that this is a good deal and he's been investing for a long time, that doesn't mean that it is a good deal. And once again, it doesn't necessarily mean that it's a good fit for you. And those are the things that I'm trying to help educate investors. Like, you got to engage your brain. You got to use your own brain. You got to think it through, because really when you pull out that pro forma, that's all you're doing, because you've been there. You've been a property manager. You know what things should look like and what looks unrealistic. You're able to say, like, your utilities are way too low, right? Like, you're just not like the utilities are too low. Like, that's not going to happen. They're going to be here instead of there. And that's going to impact NOI, and that's going to impact return. Right. Or whatever the case may be, your rent bumps or whatever the case is, like, that's not realistic, or the occupancy rate is too aggressive, or whatever the case is. So, I think that's just
it's pretty granular. It's you're looking at some sponsors are more forthcoming than others with a lot of this data. I have good relationships with some, and they'll actually show me various documents because they do their due diligence, and sometimes I'm just going back through theirs because I don't necessarily am going to have access to everything, right, as if I'm buying it. But say for example, you come across a multifamily, because I think a lot of us are more familiar with that. So say a multifamily and the rent roll, 30% of all these tenants just moved in the last 60 days, right? Like you and I, like a flag will go up, but some Wall Street guy, he's like, oh, great, they got it all full. Awesome.
Yeah.
Like depending on your background and your knowledge, you're going to look at that exact sheet of paper two different ways. Yep. For me, it's a red flag. For them, they're like, it's a good thing, right? Mm-hmm. So things like that. It's not necessarily, people just reporting data or anything.
Oh yeah, definitely. Yeah, no, I mean, I agree. So that's just it. This isn't people like trying to commit fraud. It's just the fact that people are doing what they think is right. They've got a property, they're looking at it. It's a nice property. They feel good. They feel like it's going to work out well. Some analysts behind the scenes is plugging stuff in. That's just how it works. Right. And like you said, because you have experience, you look at it and go, it just doesn't, this doesn't seem right. It's not like someone's trying to pull the wool over people's eyes. And like I said, a lot of times and maybe not necessarily in the BD space, this might be that benefit of that is that I think in the unregulated side is just that, people, they do feel the pressure. I mean, when you have earnest money that goes hard on a deal, right. And you got to raise 2, 3, 4, 5, 10, $15 million of equity in, 60, 90, 120 days, like that's a lot of pressure. Right. And so when you think about it, and I've been on that side. We've done this. It's a lot of work and, and those are the sorts of things that it's like, okay, do we go when everyone else is sort of being a little Pollyanna about their projections. And then are you going to be the one that decides that you're going to be sort of like Debbie Downer on like, well, this is what it's going to be. Like, it's really hard to sort of break from the ranks and decide to do that. And I totally get it, and that makes sense. It's just, and that's why for me, I combat it a different way, which is why we do this podcast. It's just more of to say like, okay, that's dysfunctional buying. It's like anything, there's just dysfunction in any sort of process, especially when there's multiple parties on the other side of the table, right? So dysfunctional selling practices come from dysfunctional buying practices or whatever. And it just perpetuates itself and it's dysfunctional, right? So the only way to combat that, right, is to, you got to make both sides so where they begin to start, acting more in line with how they should so that it's a more functional process. Like kind of what the internet's done for us is the ability to go research your decisions. So when consumers go to make buying decisions, they're educated. Well, an educated consumer can make better decisions. It creates a more efficient, as we've seen with e-commerce and all those things, just more efficient sales process, right? And it's the same with this stuff, and it's a little behind. And I think that's where guys like you is a breath of fresh air when you've got, because ultimately you're the relationship manager, right? Like you're the one people are coming to you and saying, hey, I've sold my property and I've got capital gains and I need to do a 1031 or do I do a DST? Whatever, right? And they're coming to you and they're saying, I've got this, wealth that needs to be managed and I need to know how to do that. And, having people who, when they go to them, have their best interest. So that's what I mean. Like you get it at a high level, what the regulators are trying to accomplish with Reg BI, regulation, best interests, and all these things. It just doesn't always translate. So with that said, for you, and maybe this is, like how does one build a portfolio of alts? Like how do you, and maybe this is where it's like, you almost have to think of it from your standpoint. Like if you were let's just use a hypothetical, you're married and you're 58 years old and you've, worked at a corporate job and, and you ended up, having some stock that you made money on. Like, how would you build a portfolio of with a heavier weighting of alts and like, how much is too much? And I know that's hard, right? Like it's hard because you have to take some contextual person, but correct. Like, how do you look at that? Like, what is it? What are the little things that in your own mind sort of tip it over for you when you're going like, okay, this is too much. This is too heavy on one side. We need some exposure to bonds or, something different.
Sure. The number one trap I see people falling into, there's two aspects of it. One is the simplest thing being real estate rich and cash poor. So you have a whole lot of illiquid investments, whether it's, the tangible real estate or just illiquid alts, right? And, if it's a life event happens and you didn't plan for it, and all of a sudden you need a lump sum of cash and you can't get to it, that's a bad thing, right? If you own, a bunch of multifamily and offices, and you've got your hotel, say you need to replace 15 water heaters, you get a call from your manager, hey, these all blew, we missed the maintenance or whatever. Here's your bill, right? What are you going to do if you're too illiquid? So that's the number one thing. Then once you have that ratio, you have to ask yourself about diversification within both sides. So what does your liquidity look like based on your needs and goals, right? Would you say 58 and I have a wife and I have kids, right? So when are my kids going to, hit those life stages, braces, driving? If I've got 4 kids, do I have 4 daughters and 4 weddings to pay for? Or, like how many kids are going to college? Or are 3 of my kids creatives and they're not going to go to college, they're going to go bike across Europe, or, whatever those things are, plans can change, but you need a plan in place of some kind, right? You need to at least have thought about it, mapped it out, know what you're getting into. So that's what your liquidity needs and timeline will dictate what that liquidity portion looks like. If you are in love with alts and you're alt heavy, that's fine too, but there can also be diversification, right? If you sold your 100-unit building and you are now in DSTs, for example, you could have, one, say, for the sake of simplicity, 125-unit tangible building, and then 3 other DSTs, one in Texas, one in Boston, and one in Florida. Like you can spread out by asset, by, an industrial, a multifamily, by you're diversified by region now. You're mitigating risk in that way as well. So even though you're in alts, you've got different classes in different regions and different exposure, and you can explore other things. There's, alts as far as, income funds and, I think we talked before about opportunity zone funds, which, that's pretty aggressive. And, to get the full tax benefit, you're looking at the 10-year investment. So you have to take that into account. That's not necessarily going to be suitable for a lot of 58-year-olds because the end of that life cycle puts you at 68. So did you want to retire at 62, 65, or is 68, 70 a realistic projection for you? We don't know.
Yeah.
I like to work with, I kind of quarterback things as the advisor, but I bring, attorneys and CPAs and anyone else who's pertinent in your life. If you have a business, right? I think you said this person works at a corporation, but say I've built a business over the last 20 years, like there's going to be what we call key man, or the key man people who should be involved in that process. What happens to that business when I turn 68 or 70? So these are all things that factor into making that plan and how you're going to implement it.
Yeah, no, and I think that's just it, right? It's like and that's hard for a lot of people because, like in this case, if you were a corporate guy or whatever, I mean, you were busy, doing whatever it is that the company did. You worked for Intel or Nike or whatever, whatever it is that you did, and like you said, you got a family, you got whatever. There's only so much time in the day to keep up on, all these different things, but to create, diversity and to think those things through. And that's why I feel like it's easy for me to sit here and just talk about, like, nerd out on specific, like in the weeds, and I'm a believer that to really understand things, you got to pull them apart and sort of look at how they work. And especially when they're broken, when things are broken, not working, it becomes easier to sort of go, oh, okay, like this is what it should do. This is what it is doing. but kind of panning out and saying, well, how does that all fit together? Maybe that's why I struggle with it, because it's, once again, I know enough to know that it is contextual, that it is situation by situation, and everyone's situation is different. And so having, like you said, that quarterback that can help you, kind of navigate that, which is, we had on the show, Ryan Parson with Mile Marker Club, and that's more of like a peer group who, kind of helps you through it or whatever, but you need something, right? I mean, unless you just know you're really good at knowing a lot of things about a lot of things and you enjoy that, then maybe you can do it on your own, right? But outside of that, it just seems to me like, you need someone to sort of help you pan out and pull you out and say, like, okay, what are we trying to do here? Like you said, like, what are your goals? Where are you trying to go? And I think that the hard thing is that most, and once again, and no fault to, I'm not judging sort of register reps or investment advisors or, IARs or whatever, but I mean, that's the trouble. It's like you're pigeonholed into the products that you have available to sort of solve these holistic problems. Kind of like, I guess what, doctors went through. It's like they got drug reps coming in and like pushing drugs, like, it's like, I don't blame them. Like, I get it. It's not great. Like that's not really what you'd want how it should be working, whereas someone who's doing holistic medicine or whatever, that's just, it used to be sort of a, what's that all about? And now, now I think more and more people are like, okay, there is, if you look at it holistically and people are gravitating to that, but I think on the planning side, it's the same thing, right? Like, being able to kind of look at it holistically and figure out how to tap into other things makes sense. Now, the reality of it is that most people who woke up this morning and are fee-based planners, is a good example, and work for a wealth management firm, the notion of alts is their definition of what's available is super narrow, right? Like super, super, super narrow. They, their definition of that might be like Blackstone's latest $4 billion fund or something. I don't even know what it is. Yeah. But, and that's problematic, especially because the public markets, in my opinion, and maybe you can speak to that, but it's just, they're so efficient now. Like, I don't even know how one can generate alpha, like return. And once again, especially if you're paying an advisor on, a wealth manager or someone on top of it, like, I don't even know how you go forward. How do you make gains? I don't even know how you do it. I mean, even obviously in the wake of this, post COVID, I mean, even some of these hedge funds that used to just crush it, like Bridgewater and stuff. I mean, they're having a hard time. Like, they're having to retune their algorithms and figure out how in the world to pull it off. So, how do you, I mean, obviously you come from the real estate side, so I think it's easier for you to sort of be sympathetic to what I'm sharing. But, now that you have sort of crossed the other side and you're sitting over there, how do you feel about that? Especially since I'm sure most of your interactions are coming from people that are more, I mean, you were in the DST thing, so you're kind of on this side, but maybe you pick up on some of that.
Yeah, absolutely. I still get, having my Series 7 and being the advisor, like I can do all these things. And I'm also very savvy on insurance products and things of that nature too. I don't have my insurance license, but I think, the other three folks at the Haney Company do. But those are also, very handy tools to be aware of, and you can incorporate it in that whole plan, right? Like life insurance, for example, doesn't have to just be life insurance. You could have cash value life insurance and be able to, instead of just having one or the other, like savings, you could have this cash value sitting there that you can either, borrow from or use as collateral when you do an investment. So in and of itself, no, you're not going to crush it with that investment. But one, it provides surety for your family while you build this up. Then you can take this, and get this return over here when the opportunity presents itself, right? Like having these moving parts, having as many tools in your belt as possible. And yeah, I do have a little more, a few more tools that I'm aware of, like you said, because of my background. I know there's a lot of, sponsors and syndicators that are not in my platform, or like, I'm not going to say, hey, don't go buy your own property, do this fund that I have, look how great it is, right?
Yeah.
There's a place for it, and getting those returns, sometimes you gotta roll your sleeves up, right? And just get out there and do it yourself. You don't want to be jack of all trades, master of none. I think you need to find, whether it's a business or real estate, getting your hands dirty, doing those, a handful of flips to build up capital or whatever. You don't want to go in blind. You want to know what you're doing. And again, don't try to do everything. But I think that's the way to get returns these days, is by doing the hard work. It's very, very hard to sit on the sidelines and knock it out of the park, with a couple clicks of a mouse or something.
Yeah.
So I think that's the bottom line. And yeah, there's a lot of really smart guys trying to duplicate that, as far as, the funds and stuff that you mentioned. But a lot of the stuff that does perform well is really limited to alternative or accredited investors because of the risk involved. So, I really wish I could take some of this stuff off that shelf and give it to the average person. It's just not available. So,
yeah.
And it wouldn't be smart to do that for, reasons that you're well aware of, but,
well, right. Well, like you said, it's sort of that liquidity thing, right? Well, if you don't have much net worth to work with, then, it's not to say that someday that there isn't some way to accomplish that, but, it's just right now, like you said, liquidity is important. And if you don't have much to work with, what are you putting it into, right? And then just, it's so small, and, anyway, that's another day's discussion, but yeah, it's interesting. And the good news, I think, is, much like, to use the analogy of sort of the holistic medicine and stuff, is like, I feel like we're all, things are moving in the right direction, right? So the SEC is broadening, access, and there's lots of good things. And so that's exciting. And just being able to, meet someone like you is exciting to me, right? Because most people that, which is the kind of thing how you got recruited into the business, right? Was just people were encouraging you, like, hey, you could be a really great asset on this side. I just don't meet, most of the people that are in your shoes, they come from that side, and that's how they get into it. And they don't necessarily, it's all textbook, they haven't rolled up their sleeves. They don't really understand it. They learn how to sell it or whatever, but they've never done it before. So, I think that's pretty neat. Well, last question for you. And once again, if you have nothing, then no big deal. But like, what's the biggest meltdown that you've seen, like, in the real estate space, where someone just like got killed? Maybe it's not your story. Maybe you heard it secondhand, but like, someone did a real estate deal and they just got wiped out, and what were the circumstances behind it? You got any good stories?
So off the top of my head, I've seen uneducated, unexperienced people bite off more than they can chew. That happens every once in a while. People will jump into a deal because they heard, multifamily is the next best thing. Don't start small, go for the 100, 200 units. And, the due diligence you do on a 12 unit versus 100 units, the same, right? Like, I'm not saying that in and of itself is bad advice. What I'm saying is, if you're not prepared to go into that space, don't go into that space. Yeah. Find someone who knows what you're doing. So yeah, I've seen those happen. I'm not coming up with one.
Well, no, that's a good one though. Yeah. Not a great, and that's okay. But that's the thing. Like, I think it points to that. It's just the notion that it is pretty linear, like, especially as an active investor, right? Like, you do kind of need to buy a house, a rental house first, single family dwelling. And then, there is this progression. It's just, and it is true. Like, underwriting a 12 unit is the same as, like, I get it. Like, that makes sense, but it doesn't mean that you just go and jump right to 150 unit multifamily deal. Right. And so it's okay for some things in life to be sort of linear. And I think that, like, it's a marathon, like, you'll eventually get there. You don't need to, there doesn't need to be a shortcut for everything. That's okay. The life's a journey. So,
and it is the marathon's a great example because the long game, if you're playing the long game and you're not trying to get rich quick or get all hyped off a seminar and go, create wealth instantaneously, I think people do a lot better. My first, it's funny, like you said, to start with that single family rental, that was the first property I ever bought, even before my own personal residence was a single family rental. And then I kind of moved on from there. And playing the long, I'm always super conservative. I even sold everything I built up to 2007. Into 2007, I talked to my wife and I was like, I'm seeing the writing on the wall. Like, a lot of people disagree with me, but I think we need to sell everything now. So she trusted me and we did. And so that's what that would be like. If I could leave another piece of advice, it'd be to be conservative. Like, it'll be okay, right? Like, it's far better. You make out better in the end to be conservative the whole time than to try to get those big wins and put extra risk on the table.
Yeah, definitely. Well, cool. Well, it's been really great hanging out with you. I thank you for your time. And we might have you back, on the show. Like I said, I'm not going to be speaking to that sort of the holistic side. I love talking about it. Like, it's great in theory. It's just not where my brain spends most of its time sort of, noodling
Absolutely.
on.
I'd be happy to, Lance. Sure.
Cool. All right, man. Well, you take care. You have a great day and we'll be in touch.
The information provided in this episode is not intended as specific tax or legal advice and may not be relied upon for purposes of avoiding any federal tax penalties. Skyline Views, the Haney Company, their employees, and representatives are not authorized to give tax or legal advice. Individuals are advised to seek advice from their own tax or legal counsel. Individuals involved in the estate planning process should work with an estate planning team, including their own personal legal or tax counsel. The information provided here does not constitute personal financial advice, but is meant for the conveyance of information for educational purposes only. All investing involves risk, including the risk of loss. Past performance is not indicative of future returns. Guarantees are backed by the claims-paying ability of the insurer. Christopher Mills is a registered representative of Coastal Equities Incorporated and an investment advisor representative of Coastal Investment Advisors Incorporated. Neither Coastal Equities Incorporated nor Coastal Investment Advisors Incorporated is affiliated with Skyline Views or the Haney Company. Advisory services are offered through Coastal Investment Advisors Incorporated, a U.S. SEC registered investment advisor, and securities are offered through Coastal Equities Incorporated. Member FINRA SIPC, 1201 North Orange Street, Suite 729, Wilmington, Delaware, 19801.